I think a lot of investors have had trouble believing that it would stay under control. The way inflation will stay under control is productivity growth, and we're already seeing strong productivity growth thanks to artificial intelligence and other new technologies, as well as actually the dollar firming. Most commodity prices are priced in dollars. Most commodities are priced in dollars, I should say. And the dollar going up means downward pressure on commodity prices. That's a very good thing as well. So what will happen to interest rates here? Now, this is a little different from the 80s. Interest rates were so high at the beginning of the 80s, 15%, that really, if the Reagan administration got anything right, those interest rates would come down. And they certainly have. Now, 45 years later, they are high relative to recent history, 5% on the Fed funds rate. And they are restrictive relative to where we see inflation going. So we do believe there will be a downward pressure on interest rates, maybe even more than many investors expect in the near term, because I think a lot of activity is going to be held back by, a desire to understand how policies are going to change in the future. If we believe tax rates are going to come down, we're probably going to wait. If we're businesses and consumers, this is classic. It even happened during the Reagan administration when he phased in tax cuts over 3 years. Most people just waited until the tax rates were at the point he had promised. So we probably will see some holding back of activity in the next year in anticipation of even lower tax rates. So I think interest rates will be biased to the downside. Thereafter, I think we're going to see an explosion in productivity growth.